Warm welcome to all of you. And today's session is whether it is time to buy or sell. These topics are decided based on the kind of feedback we receive at Smart VRC. And this is A K Asnani from Smart VRC Bhopal. And let's begin today's presentation. And the estimated time is about 30 minutes. So we are starting with a poll, and most of the times we do start with a poll so that it remains interactive and let all know what an average investor thinks. So the question is, please indicate your investment horizon, whether it is less than 3 months or, it should be 3 months, 3 months to 2 years, or 2 years to 5 years, or more than 5 years. So it is on your screen, and as usual, I request all of you to participate. Okay, 70% of the participants have given their verdict. Waiting for more. Yes, looking for more participation. 5 seconds left. Well, we are ending this poll. And here are the results. No one has chosen the option number A, that is less than 3 months. 18% have gone with 3 months to 2 years. 33% with 2 years to 5 years, and 49%, a big chunk, for more than 5 years. I am very happy that more than 49%, it is 49% of the participants have gone for more than 5 years, and that is the way to create a wealth. Thank you, participants. So the today's webinar contents can be categorized like this: present fall in perspective, and it is the stocks which create the risk, not the market, and I shall show you how. And has the market peaked? There is also a very burning question in the minds of investors, and what should be the strategy, and to be followed by the question answer session. So the first is the present market in perspective. Yes, we should have a good perspective, good rather I should say, what is your philosophy of investing and how you look the stock market, right? So this is the present fall, as you can see, and this is a long-term stock market trend, and this graph has been taken from Google Finance, and this is for a period of more than, I think, about 35 years. Yes, it is about 35 years. And you can see that the fall, these falls we have seen many times in the past, and almost many times in a year. Yes, if you go in terms of percentage, you will find that there are many such falls even during this period, when you are able to see only a kind of a straight line, because this is not a logarithmic graph. So in terms of percentage, we have seen such falls several times. In fact, this fall is very small in many ways. Let's see what I mean to say that in many ways. So this is the gain of BSE sensitive index since 23rd March 2020, when it touched 25,900, something like that. And from there on, it is up by 123%. It is a big gain, 123% in a matter of about 20 months. So those who are invested since 23rd March 2020 or before that, they are sitting on good gains, very good gains, healthy gains. As far as the S&P BSE mid-cap index is concerned, it is up by 152%. So it is up by 30% more from the BSE sensitive index. And what about the small cap? Small cap, oh, it is 206% up. So an investment of 1 lakh has turned into 3 lakhs. More than 3 lakhs within a period of 20 months only. And most of the retail investors, they are invested into mid cap and small cap only. So they have made very good money. On an average, about 180% in terms of the indices. And if you are a good stock picker, smart investor, then I'm very sure you must have earned much more than this. In one of our schemes, that is SBP, the value has grown from 42 lakhs to 134 lakhs. Yes, it is more than 206%. So that is the kind of returns smart investors have derived during last 20 months. Now, this pertains to average change per month of 5.9% for sensitive index. Mid cap it is 7.2, and for small cap it is 9.8%. That is average. Okay, this is not compound. Just from the perspective, I'm telling you, for the average gains of 9.8% per month in small cap index for 20 months in a row, just imagine 9.8% returns you will earn in 2 years in bank FD if you remove the tax. So it will take 2 years, and here you have earned every month, and that too for 20 months in a row. That is phenomenal returns we have earned from stock market, not only in small cap index, but even in sensitive index and mid cap indices. Now, what we are worried about is 6.6% loss. I should not say loss. It is a fall from the peak for BSE sensitive index, 6.6% for mid cap, and only 5.6% for small cap. From the peak, from the recent peak that happened around 18th of October 2021 for all these three indices, we are down by only 7%, maximum 7% in terms of index. So why we are so much worried? The question is, if you have earned 9.8% every month for 20 months in a row, and if the market is down by 5.6% for small cap indices, why we are so much worried? We don't want to lose. We don't want to give away even few percentage gains. If that is the attitude, then let me tell you, it is very difficult to create wealth in the long term. Yes, it is very, very difficult. And as you have indicated in the results of the poll, that 49% of you are investing for more than 5 years. If you are investing for more than 5 years, then why to bother about just a 6% fall from the peak in a period of not even 2 months? Okay, that is the perspective. That is how one should look at the market. Now, what has happened in our recommendations? In Smart Gains, this is a period for only 2 months. During last 2 months, these are the stocks we have advised. The stock names have been hidden, and these are the kind of returns as on date. Okay, these are the kind of returns as on date. Average is 2.43%, and during this period, Sensex has lost 4.1%. So on an average, yes, we have done wonderfully well. But if you go by stock wise, you will find that there is a huge variation. There is a stock wherein we have gained 16.78% within a month, and there is a stock where we have lost 11.36% within 1.5 months. So yes, stock wise, there may be losses even in your portfolio, but overall, we are doing extremely well. I should say extremely well, because we are investing from 3 months to 24 months in smart gains, but even during the last even during last 2 months, the gains with respect to the BSE Sensex are very good. So that should be the way to look at your portfolio. Look at your portfolio, how much it is down with respect to the BSE Sensex, with respect to the BSE mid cap, with respect to the BSE small cap. Don't go by individual stocks. Yes, it is required if to go by individual stocks only if the losses are more than 15% or 20% in a single stock. Then definitely it deserves attention. It is not only smart gains, but even in smart multi-bagger, herein we have published the information from 1st of January this year because it is a long-term investment product. Smart multi-bagger is meant for those investors who are willing to invest from 2 years to 5 years. Herein, our average gains are 19.91% with respect to 13.7% in BSE Sensex. Once again, here you can find wild variations. There is a gain of 156% in a matter of only 11 months. Also, there is a stock which returned 116% returns in a matter of only 9 months. Also, there is a stock with a loss of 26% during last 4 months, 24% loss during last 2 months. Yes, but we are not disturbed. Why? Because we are investing for long term. If I have given you an investment horizon of say 4 years, then why should I disturb my sleep for a loss of 24% in a matter of 2 months, provided there is nothing wrong with the story. If the story is intact, nothing to be worried. So that is the perspective. Always think, if you are a long-term investor, then it hardly matters where the stock is moving as long as the story is intact. So that should be the way to look at the stocks, to look at your portfolio. Now, poll number 2. Though the stock indices are down by only 7%, still I am worried. Why? Why you are worried? So option number 1 is my portfolio is down by more than 15%. Maybe. Some of my stocks are down by more than 25%. Omicron. Fourth option is I started investing recently and it seems market has peaked. So these can be the one of the or multiple reasons could be there in case of individual retail investors. And let's see. So options are available on your screen and you have to opt one of the options here. And it is possible that there can be multiple options which are applicable to you. So the one which is the most appropriate, you select that. So participation is a bit less. Maybe you are thinking a lot which option to be selected. Okay, I will give 5 seconds more. Well, 32 of the participants don't want to tell, or rather they even don't know, or it is possible that they are not at all worried. That is also possible. So these are the results. 14% are worried because their portfolio is down by more than 15%. Okay, and then again 14% more for some of the stocks are down by more than 25%. Yes, it is a reason to get worried, and it is time to investigate why your stock is falling. Not necessarily because of some negative news. It is also possible that just because of the volatility, and 23% because of the Omicron. We all know Omicron. And 16% because they started investing recently. Yes, they deserve to become scary. It is very natural. If you have started recently and if it is in loss, then it really scares you because it is your hard-earned money. But nothing to be worried. If you are invested for long term, then nothing to be worried. And the 34%, and that is the maximum. It seems market has peaked. So this I was not expecting. Okay, it seems the market has peaked. 34% say that because of this they are worried. So if you are a long-term investor, you should not worry about the market peaks. You should always worry about your stocks if it is down, it is going down with respect to the stock index. Well, thanks for your participation and thanks for giving your view. So if your portfolio is down by more than 15%, it is very much possible that you are, rather your stocks are trying to discount too far into the future, maybe 3 years, 4 years. So there is nothing wrong if you have the stocks which you have purchased with 4 years in your mind, and for some reason if the stock is down, many times it is possible that it is a mid-cap stock and there is not very heavy liquidity and some big investor wants to offload, then also the stock goes down, and that gives in fact an opportunity to average rather than getting fearful. And some of the stocks are down by more than 25%. This we have already covered. Omicron, okay. This is a kind of a mutation of the COVID, and it is quite possible that many more such mutations we may have to see. But one thing is certain, market, as far as my knowledge goes, has never crashed 2 times for the same reason. In fact, I started in 1989, and since then, what I find is that it has never happened that market crashed 2 times for the same reason. Because once the market crashes, then you learn a lesson. Not only you learn a lesson, but even the governments learn a lesson. And as far as I remember, in early 90s, there was a boom in soybean growers, soya oil processing companies. And that was because of the shortage of foreign exchange, and soya was exported mainly to US and other countries, and it was a hard currency earner. And there was a boom like anything. And subsequently, there was a crash in soya stocks. And since then, I have never seen further boom or crash in soya stocks. Come the year 2000, there was a crash in dot-com bubble. It is known by dot-com bubble. But since then, there is never a crash in IT stocks. Similarly, in between this early 90s and between 2000, there was a boom in paper sector. And then there was equally fast crash in paper companies. I have never seen another boom or crash in paper sector. In 2008, there was a crisis in real estate. Since then, we have not seen any real estate crash. So I hope in the year 2000, we saw a crash because of the COVID. And because at that time, there was no solution. And it happens with every crash. In the beginning, you do not see any solution. So in the month of February, March, April, there was no solution. Subsequently, vaccines were developed, not only in our country, but across the world. And as we saw, more and more people got vaccinated. So economies are reviving up. And now we are confident that even with Omicron, we shall be able to develop a vaccine. We have a confidence. Okay. And also, this has been told by one of the leading vaccine producer that they can come out with a solution for this also within a period of 6 months. So even, of course, Omicron itself, we do not know how dangerous it is, because as per the WHO, it will take time to tell. So such type of fears will be there in the market, especially for the fresh investors. I would like to tell them, market will not fall without any reason. There will be reason, and that will create fear. So the option number 4, I started investing recently. This also we have covered. And the last one, it seems market has peaked. This we will cover in the subsequent slides. Now this is the chart. This red color is the BSE sensitive index chart. And you can see a kind of very smooth type of curve. There are hardly any sharp ups and downs, but you won't be able to find out where is Omicron. Here it is Omicron, but such type of segments you will be able to find many times, maybe hundreds of times during this duration of 21 years. And this blue color is the smart billionaire picks, and here also you will find such type of falls many times during this journey. So these type of threats is a kind of a regular threat. If it is not Omicron, then it may be some inflation, or it may be some increasing rate of interest rate. Some kind of threats will always come. Be prepared for that. So coming to the topic number 2, stocks create risk, not the market. It is a general perception that the market is very risky. Market is risky for those who are involved in very short-term investment. Rather, I should say trading. If you are a day trader, yes, then how the market behaves, your stock will also, in all probability, the stock will also behave in that fashion. Okay, there is hardly not even 1% of the stocks which move the other way. But as you increase your investment horizon, it is not the market, it is the stocks you are invested that decides your risk. So let it be very clear, what you see in the short term, on day-to-day basis, or even on weekly basis, even on monthly basis, is only a volatility. It is not risk for you if you are invested for long term. It is not a risk. You should love the volatility. Yes, if you are a real investor, if you want to create huge wealth, then you should love the volatility, because you have the confidence on your stock. And if you have the confidence on your stock, you will always love that either stock price should come down or it should move up. Because if it comes down substantially, then you will get an opportunity to buy more and bring down your average cost of acquisition. If it moves up, then give you an opportunity to book profits if it moves above your worth of the stock. So you should always love the volatility. Yes, I do love the volatility. So as we have already covered this, most investors think all stocks pose the same risk. Yeah, there are especially the new investors and the potential investors. They think all stocks pose the same risk. No, it is not like that. Every stock has a different kind of risk. And there are basically two types of risk. The number one is associated with the market, because in the short term, as I said, the stock moves with respect to the market, in line with the market, rather, I should say. So you cannot do anything. You cannot remove that risk. And that is known as beta. Beta means in how much proportion your stock will move with respect to the market. If the market is down by, say, 10%, and your stock is also down by 10%, then beta has a value of 1, unity. So every stock has a different relation with the market. You cannot do anything. You cannot diversify away, or you cannot remove this risk. It is not removable. There is a systematic risk. There is a non-diversifiable risk. There is a market risk. It is the second type. It is the rest of the part of the risk is in the underlying company. What the company is doing, that decides your returns. That also decides your risk. So no, you should know what you are doing. You should know where you are investing. If you are invested in wrong stock, I mean to say a very risky stock whose chances of company's performance improving year after year are remote, then you are investing in a very risky stock. It hardly matters how good patience you have, how long you are invested, because you have chosen the wrong stock. So I hope you are able to distinguish what is the market risk and what is the non-market risk. And this risk can be reduced by diversification, by including more stocks in your company, in your portfolio, so that every company has a different kind of risk return behavior. So that is what I was saying, diversify your portfolio, not only from the sector point of view, but also in terms of the management. Don't have the same management, don't have many stocks with the same management, don't have many stocks from the same sector, right? Risk is also associated with the allocation in portfolio. This is very, very important. Recently, it happened that one of our stocks was down by 13%, and my subscriber called me up and he said that he's under immense pressure because the stock is down by 13%. Then I said, well, 13% is very normal type of thing, and you should not be bothered. Then he said that, sir, my 81% of the weightage is in that stock in my portfolio. Yeah, then it is a problem. So as far as the stock movement is concerned, it is not a problem, but you have allocated wrong weightage. You have allocated 81% to the same stock in your portfolio. So this plays a very crucial role. So as you can see, risk is not into the market. If you are a long-term investor, risk is how you allocate the stocks in your portfolio in terms of the sector, in terms of the management, in terms of the weightage, and how you select the stock. Risk is also ascertained by the time horizon. This I covered very initially. If you are invested for a single day, then volatility is the risk. If you are invested for 5 years, then day-to-day volatility has hardly any meaning. So this I am repeating once again from last 4 webinars. I am repeating why these 2 category stocks. Stocks category number 1, poor fundamentals, poor story, and high valuations. These are the most riskiest kind of stocks. They can destroy your portfolio returns to a great extent. Second is strong fundamentals, decent story, but very high valuations. Yes, this is another kind of stock category wherein the fundamentals are strong, story is decent, but valuations are way high. There are stocks with valuation. There are many stocks, rather I should say, with a P ratio of 100 plus, and the growth rate is not even 15% per annum from last more than 10 years. So these are the stocks which may pose risk in a sense. They may not get you even the Sensex equivalent returns. And also recently, many stocks have listed what people say is the new age stocks, where the companies are deep into losses and there is no profits in sight in the near term, or rather I should say in the visible future. So be very careful such category stocks, and even if you like those stocks, then have a very low weightage in your portfolio. Now we come to the third point. Has the market peaked? This as far as the intermediate peaks are concerned, maybe whatever we saw around 62 Sensex level of about 62,000, that was a peak in the recent past, but we are only hardly 7-8% below that peak. So we cannot say that the peak has already been formed. Yes, from the short-term perspective, peak has been formed. But had ever anybody has consistently identified the peaks successfully? How many times? Tell me a single person which in the month of March 2020 told that the Sensex will rise by more than 100% in a year. No one. No one can predict whether it is a peak or bottom. Then why we are worried? Who we are to identify what specialty we have to identify the peak. Yes, there are some signals. Under the natural economic cycle, the peak cannot arrive because peak cannot arrive without the rising interest rates. And presently, we have not seen even 100 basis increase in interest rates in India, right? Even in US, they are hesitant in increasing the interest rates. We have just even not started the cycle of increase in interest rates. Then how can economy peak out? So as far as the natural cycle is concerned, there is no peak visible. We cannot say that peak has come. But as far as the retail investors' emotion is concerned, I can say very well they are behaving as if making money from stocks is very simple and very easy, and they are buying fearlessly. So these are definitely not good signs. So maybe market has to adjust, has to consolidate at current levels before making a next move. But let me tell you one thing, whenever such situations arise, there is a lot of inefficiency in the market. When I say inefficiency, means it is like this. Suppose there is an investor X. He has invested in a very good company, and he has invested about 15, 18 months back. He's sitting on good profits, and now the stock is down by 6-7%. For the first time during last 18 months, he becomes scary. He feels that I have not earned any return during last 2 months. I should switch to some other stock. And therein comes where he goes for a risky bet. So change of ownership from good stock to poor stock. And this keeps on changing. This happens mostly with the new investors and especially with the retail investors. So as far as the natural economic cycle is concerned, no. I say no, market has not peaked. Yes, there are risk of high inflation because of the disruption in the raw material, not because of the demand pull, right? It will be a long time. As far as the natural economic cycle is concerned, we are nowhere near the peak. And if you are a long-term investor, suppose in my case, I am into the market from last 32 years. I have seen many peaks, but I have never sold off. Knowing that, yes, market may not go much beyond this point, even then I have not sold stocks just because the market may fall down. I have experienced, no one can predict. So the best strategy is to have the good stocks in your portfolio and let the market move wherever it wants to. And you have to keep track of your stocks, not the market. Keep track of your stocks, where they are heading. They are heading in terms of the story. Ultimately, stock has to follow that story. It happens every time without fail. Yes. Okay, which country index has gained the most in last 5 years? Okay, this is very interesting. Last 5 years. So options are available on your screen and you can opt. Anyone? So options are BSE index, that is India, NASDAQ, that is USA, Hang Seng, that is China, and fourth is FTSE, that is UK, and last one is Japan, Nikkei 225. Which country index has gained the most in last 5 years? Okay, only 5 seconds left. This time we are seeing a good participation. Okay, we are ending the poll. So this is the result. 71% had voted for BSE Sensex, 22% for Nasdaq, and Hang Seng is 5%, FTSE UK is 0%, and Japan is 2%. Okay, let's see the results. So here is the result. Blue one is BSE sensitive index. This is the blue one. Nasdaq is in yellow color. Highest gainer is Nasdaq, and that is 177%. BSE Sensex has increased by 115% during last 5 years. And Hang Seng, that is the Chinese index, that has grown by only 4.42%. All right, only 4.42% during last 5 years. FTSE index by 2.42 and Nikkei by 47.55. So the winner is Nasdaq. It has grown by 177%. And as you can see from this chart, the outperformance for Nasdaq has started from the last 2 years. Technology has taken a lead, and that is why Nasdaq has gained. And also, we should not forget that Nasdaq is mostly a technology-intensive companies, stocks of technology-intensive companies, though in a sense, the Nasdaq is not truly diversified as far as the sector is concerned. So that way, I would say that BSE Sensex has done wonderfully well with 115% returns. Now, some of you would be wondering that since 23rd March, BSE Sensex is up by 123%, and during last 5 years, the BSE Sensex is up by only 116%. That is what I say. No one can predict the market. No one could have imagined that BSE Sensex will fall to below 26,000 levels on 23rd March. So better remain invested in good companies rather than trying to sell at peak and trying to buy at bottom. We can help you a lot as far as the education is concerned, as far as the investment is concerned. Our website is smartverc.com, and we have, apart from the stock advisory, we have small 20 minutes videos and a bunch of about 15 videos in each category. Also, I'm author of the book Way to Billionaire. You can purchase from the website, that is smartverc.com. And also, we have got free financial freedoms calculators through which you can find out how much money you need at the time of retirement and what kind of returns you will require to achieve that money with the present investments. So this was all about Smart VRC. Strategy that never fails. Yes, this also I keep sharing again and again. Always think long term. During the peak, no, not peak, during the crash, we always thought what would happen 2 years hence, 3 years hence. We were not bothered why the market is falling or stocks are falling like anything. We were not that much bothered. We were bothered what will happen 2 years, 3 years hence. We were thinking ahead. So very simple thought process, very simple. Relaxo share price came down by 50%. There was complete lockdown. Simple thought was like this. Even at home, people will wear chappals, the slippers. Raw material prices was PU and other crude oil related. So, and as we all know, for a period, the crude went negative also. So company and the stock price offered multiple reasons to buy, and with the perspective that 2 years hence or 3 years hence, we should be able to come off with vaccine and the resolution for this problem of COVID. Fortunately or unfortunately, means I cannot say that what happened. And within a period of 8 months, we were able to double there was a doubling in share price of Relaxo, and we never thought that within 8 months this will happen. And there are many stories. Motherson Sumi, Indian hotels. Thought process was very simple. In coming 2 years, 3 years, we shall be able to overcome this problem. So think long term. If today you are thinking of another mutation, another Omicron, then think of 2 years, 3 years hence, what will happen? How fast the technology is changing, how fast the EVs are coming. Recently, there was a statement from a leading EVs component supplier that the projections, what has been made for 2030 may come much before that, may come true much before that. That is, we should have such kind of stories in our mind before investing. So think long term. What will happen 2 years, 3 years, 4 years hence? Keep only positive stories. Don't think of dream kind of turnaround in companies. That will never happen. And even if it happens, that is not sustainable. Pay attention to valuations and weightages. Be rational. Spend some time with your stocks. When I say spend, that means spend some time with the results. Company declares the results. Spend some time with the statements given by the chief executives, or what we say is CXOs of the company, chief financial officer, chief executive officer, what they say, chairman, what are their views? What are their views about the economy? What are their views about their own company? What they are thinking about, what they are going to do ahead? What is their ESG plan? Like that. So you feel the ownership. Ultimately, if you are investing for more than 5 years, that means you are a kind of an owner. In fact, buying a stock means you become an owner. So you should have a feeling like that. Will you sell the company if the market is down by 10% or even by 50%? Will you sell your company? Have you ever heard how many people have sold their company? Only those companies have been sold who are in high debt. Otherwise, no one has sold any company during the COVID. So think like that. Why do it yourself? Yes. If you are a new investor or if you have an experience of less than 15 years, even 15 years, I'm saying, then you need a mentor, kind of a mentor advisor. Yes, you keep on learning, but until and unless you have seen at least 2 crashes, I can tell you with confidence, it is very difficult to gain a kind of conviction required to win in the stock market. Now the question arises whether it is time to buy or sell. That is the prime question, and that is the topic of our webinar. Definitely, if you are worried about the market peak, then I would say don't get worried. You are invested for long term, and if you want to sell just because the market is at peak, then forget it. Don't sell. Of course, if you are in need of funds, maybe 6 months from now, or even for 1 year from now, then definitely you should sell. But in case you need the funds, don't remain invested in the market just for a period of 1 year or even for 2 years. Don't take that risk, right? Is it time to buy? Yeah, time to buy is always there. There are always good stocks. You have to find out a better story for your portfolio with respect to the present stocks. If you are able to find, suppose you have got 15 stocks in your portfolio and you find a good story, which is the least good in the portfolio, then yes, you can buy that stock and sell, exit from the least good story in your portfolio. Averaging, yes, my experience says that one should average only if the stock price is at least 15% below your last purchase price, right? Also, you have to ensure that you are maintaining the allocation, what I say, the weightage in your portfolio, then only you should buy. You should have full conviction, then only you should average. I have seen many people, suppose the share price is 4,000 rupees and the share price comes down by 300 rupees. Immediately they buy more. What you are doing, man? Sir, average कर रहा हूं. भाई 4,000 के शेयर प्राइस पे आपका 300 रुपए शेयर प्राइस नीचे आया है. What is the percentage? Hardly 8%, 7.5%. Don't do like this. If it comes down further by 400 rupees or 300 rupees, then what you will do? Again, you will buy more, do averaging. We have got limited funds. We cannot keep on investing. So be very systematic and disciplined as far as the averaging is concerned. Don't be in hurry. Always look in terms of the percentage, 15%. So if the stock price is 4,000 rupees, if you have purchased for 4,000 rupees, then your averaging is required only if the share price is down by 600, 700 rupees. Then you should think of averaging. There are a lot many other things about averaging, and for that we will have a separate webinar, how to average. So I want one favor from you. Firstly, if you are a new investor and you are attending our webinar for the first time, then I would like to share with you that we have got WhatsApp groups, and that those WhatsApp groups are city-wise, and those are admin-only WhatsApp groups. And if you want to be included in those groups, then you can send your name and city on this number. This is our WhatsApp number. Also, you must be able to see on your screen by the side of my face, and the number is 9755920780. Also, you can invite your friends, your relatives, and hardly a message is shared in a day in these groups. Smart word. There will be thousands of reasons in your lifetime to scare you. Yes, in a stock market, almost every 3-4 days, you will find one reason that one should exit from the market, or that creates an anxiety, that creates a fear. But then if you want to be a winner, then you have to learn to dance with them, with fear. You will have to learn. Yes, there is no other way. And be confident, the stocks you have purchased, be confident on your mentor, be confident on your advisor, be confident on your own study if you are into the market for last more than 15 years or 20 years. With this, we have come to the end. Thank you very much. Yeah, if you have the queries, you can write in the chat box, or even if you can raise your hand and I will ask you one by one. Okay. Question is, Omicron. Someone has shared that Omicron may be blessing in disguise because it may be casualty of start of endemic. Okay. Your view on QSR sector because of very high valuations and good long-term story. Okay. How many stocks you have seen, how many companies you have seen in QSR sector which are reporting consistently good growth in net profit? There are very, very few. your view on Trident. Okay. Normally, we don't discuss about the individual stocks, but you have asked for a Trident. So what the least I can say is look for the abnormally high rise in share price and what has happened into the betterment of the story of the company. One more thing, it is a diversified company. So how can a management be so successful and so many different sectors? I'm not saying that it cannot be. It is possible. It all depends on our study. Also think of when a company is in operation from last so many years, then what has changed? There must be some change. Then only we can think of, then only it is digestible that the share price is so much of, has grown so much or is down by so much. There has to be some change. What is that change? Then only you should invest. And also you should look for the valuations. If you are unable to find the worth of the stock individually, then look for the comparison with other stocks in the same category. That is the best solution. Will it be wise to invest lump sum at this point in time? Okay, I always suggest that don't try to predict the market. At the same time, I would also, to be on a safer side, I always recommend to invest in at least 2 or 3 phases so that it averages out. And if you have got, suppose if you have got, say, 20 lakhs to invest, just an example, then definitely you can invest about 6 lakhs today and then the remaining amount gradually. So that is the best way. But if you are investing for, say, for more than 10 years or 20 years, it will hardly matter. It will not matter much. If you want to have a feel, then I would tell you, go back 20 years into the BSE sensitive chart, and you will be surprised to know that even if you are months here or there, it will not make much difference. And there is equal probability of going positive or going negative. So don't try to be very perfect as far as the investment timing is concerned. This is a very good question. Which is better, IPO or investing fundamentally a strong stock with good story? See, try to understand what is an IPO. IPO is an opportunity for the company investors to list their shares on stock exchange. Now the question arises, why they want to list their shares? One of the reasons could be to find the valuation of the stock, because if it is floated, if it floats an IPO, there are a large number of investors and they can truly value the company. Secondly, it gives an opportunity to exit, to partly exit from the company. So it can be promoters or it can be investors also. And when you are exiting, when you are trying to exit from the company via an IPO, what would be your objective? In general, the objective would be to garner as much premium as much possible. Also, before coming out with an IPO, the regulations are pretty less as far as the disclosures are required by the stock exchanges and SEBI. Post IPO, you have to report each and every small things to SEBI and stock exchange, but pre-IPO, very less information is available, so you cannot make out. Also, dividend policy I have seen in many companies post-IPO dividend policy changes. So it is really very difficult to find out the worth of the stock when the seller wants maximum premium from the market. And that is the reason why during last couple of months, in as much as 75 to 80% of the time, we have advised to avoid. That is the reason. So if you ask me honestly, in general, what the retail public thinks is IPOs are safe. But in my personal opinion, stocks from secondary market are much safer than IPO. Which EV company share is low and to invest now? Sorry, I will not be able to give the stock name. And your smile also reciprocates the same. Okay. Mr. Mohit Sajdev. Yes, sir.
Good evening, Asnani ji. Thank you so much for such a nice presentation, and we've always learned a lot of things from you. Sir, as per my knowledge, automobile industry is a very big indicator of the economy.
Yeah.
And four-wheelers are not doing good because of chip shortage.
Yeah.
But what's wrong with two-wheelers? The economy is booming. People are buying everything except for two-wheelers.
Yeah.
Two-wheelers is definitely a good indicator. So, I mean, is there any indication regarding economy because of this, or in particular to this sector in two-wheelers, any particular issues going on right now?
Okay.
Your view, sir. Thank you, sir.
Yeah. There are a couple of reasons what I can make out. What has happened during the COVID, during the first phase as well as the second phase, which category of people have suffered the most? It is the middle and lower middle class who have suffered the most. And now they are scared, they are fearful. Whatever emergency funds they have, if anybody unfortunately have fallen sick due to COVID, they have spent money like anything on COVID and also on the protection. And also many of the mid and below mid segment people have seen cut in their salaries, and many have lost the job. And this is that category who buys the two-wheelers. Secondly, EV has come pretty fast in two-wheelers, and many people are waiting for EVs, like Hero Motocorp. They have declared that they are coming out with the EV in maybe, I think in February or March 2022. Suppose I want to buy a two-wheeler, definitely I would like to wait. People are waiting for the EVs from reputed manufacturers. Also, there are many EV manufacturers who have done wonderfully well, and they have grabbed a lot of market share from our traditional two-wheeler manufacturers. So there are many reasons. And also companies like Bajaj Auto, they export their two-wheelers to many countries, and many of these countries, a good proportion of these countries are passing through severe COVID disease. So virus, rather I should say. So these are the reasons which I can foresee. Even the two-wheeler companies, maybe it is, whether it is TVS or it is Hero or Bajaj, all are focusing on EVs. So that is the reason I can see. And why the four-wheelers, you said that four-wheelers, there is a good demand. Yes, and you must have noticed that there is demand is more towards premium category cars or towards SUVs, which are high priced. So as far as the high priced, higher HNIs, we can say HNIs or higher middle class, there is no shortage of funds. In fact, मैं अगर सिंपल इसमें सोचूं तो देयर इज अ थॉट प्रोसेस, ये जिंदगी न मिलेगी दोबारा. So this is what I would like to say about the automobiles. As you rightly said, there are lot many sectors dependent on automobiles, and it is very much necessary for automobiles to do well in order for the economy to do well. But at the same time, there is one more sector which has more weightage in the total economy, and that is real estate, and that is doing very, very well, very, very well. So I think as the time passes on, you will see more demand. Apart from booking the house, they will definitely come out with, means the developers and constructors, they will create more demand for the cables, for the appliances, and for the wood and everything, paints, cement, steel. So I think that is more important. And presently we are passing through chip shortage. Not only chip shortage, also we are passing through a very steep hike in steel prices. So maybe in the automobiles, there are indications from some companies that yes, the chip shortage is easing out, but it is too early to bet on this logic. I hope I answered to your query. Yeah, any other query? Okay, with this, we have come to the end of today's presentation. Thank you for investing your valuable time. Thank you very much.